So, Lizanne, let me start with you. I know you don't really recommend investing based on sectors. You really rely on factors. But tell us about the banks. What do you think about the banks right now?
Well, it's been a unique rally since the October lows. If you use the simple definition of plus 20%, you're in a bull market without really any participation on the part of the banks, which is unusual. And I think for sustainability in a move higher, you're going to need some participation. Obviously, there's also been that bifurcation between the larger banks that came through the banking, I'll use Jamie Dimon's word, incident in March, um, in much better shape than the smaller regional banks. And you have the kind of double or triple whammy in the case of the smaller and regional banks with the recent downgrade, the fact that you've had the deposit flight, and just concerns about commercial real estate, which the exposure within the regional and smaller banks is much higher to commercial real estate and the woes in the office side than the large banks. So we're not out of the woods yet, but I think the waves from the March problems have clearly died down.
Chris, what about from your point of view? We did have that Moody's downgrade on some smaller and regional banks here. And they do have, as Lizanne just said, they've got an issue. They have to pay more for deposits than they used to pay before. And there is the commercial real estate issue lurking out there that we're told is more of an issue for regional banks. How big a problem is it?
Yeah, so I think there's a couple of things to look at when it comes to the regional banks that are just, and it's a question around the underlying strategy, because I don't think you can look at all of the banks in the same way, but you certainly can delineate between the large GSIB banks versus the regional banks. And it's a question around, so one, what is really pressure on profitability? So we were talking about capital requirements in Brian Moynihan's comments, but then looking to even just flows away from deposits into T-bills with the very attractive yield and money market funds, that puts pressure in terms of profitability. And then if we break down the commercial real estate market, so banks overall, so looking across the entire sector, are about 54% of that market. And then you have about 70% within that are the smaller regional banks. And so when we look into if we're in a higher interest rate environment for longer, if we go into 2024, this is something that could put pressure, especially on those banks that have high levels of exposure to that sector. And one last comment, it's not just all commercial real estate. It really is a function of, we have to delineate both regionally as well as within that space where you're looking to areas, really it's office space more than anything else.
Lizanne, I wonder from your point of view, there is the issue for the group of banks and whether you invest in their stocks or not. But there's also the larger question about the growth for the economy. I mean, can we grow the economy the way we need to really support the stock market, for example, if the banks don't feel they can lend as much?
Well, that goes back to sort of the classics of what happens when you go through an economic cycle. When you have tighter monetary policy via a Fed hiking cycle, and of course this has been the most aggressive one on the upside in about 40 years, you get a significantly inverted yield curve like we have gotten. It doesn't immediately start to crimp lending, but even before Silicon Valley Bank failing in March, the Fed's SLOOS, senior loan officer opinion survey showed that credit conditions had tightened into recession territory. So given the old line of credit is the lifeblood of an economy, as it starts to feed through with long and variable lags, it ultimately does start to crimp economic growth via that investment cycle. And we haven't seen it in earnest yet, but to suggest that this time is different and we're not going to is probably too complacent an assumption.
There's also, I think, Chris, a question of supply demand. Is it a matter of there's not the credit to extend, or is there the demand for the credit? Are the businesses asking to borrow as much as they were before?
Yeah, so I think that is a question, and also it's both demand side. So when you look at just the overall, like particularly within commercial real estate, and you look at volumes in terms of origination, that's fallen down substantially. I mean, you're looking at year-over-year numbers close to 60%. But I think the more interesting question that we're getting a lot from our investors is actually when you look at these sectors that have lagged, are they a buy at these levels? For financials, I would say go in the direction of preferreds, which is really a play on the balance sheet as opposed to the equity, which could be challenged from some of these profitability considerations.